Y a continuación ponemos el foco en Wall Street y en el estado de la economía estadounidense. No solo nos vamos a centrar en la clave bursátil, sino también en la clave macro, a tenor de toda la cascada de referencias que tenemos hoy. Encuesta ADP de empleo apenas 2 días antes de conocer ya el dato oficial de la Oficina Laboral de Estados Unidos. Balanza comercial, que además veíamos una mejora en la cifra del déficit que arroja Estados Unidos, y además también PMI de servicios de Standard & Poor's Global y PMI de servicios de la firma ISM. Son algunas de las cuestiones que vamos a aprovechar para analizar en los próximos minutos, y para ello contamos con Jay Pelosky, founder at TPY Advisory. Jay, thank you so much for having us a few minutes.
Hi, Marta. Nice to see you again.
Jay, we have so many data today. U.S. private payrolls rise in September. We are seeing the ADP numbers, and we are awaiting the jobs report of this Friday. Do you see a resilient labor market in the U.S., and what does it mean for the Federal Reserve?
Well, I think the last part of your question, Marta, is really the most important one, right? What does the Fed think about the labor market? And that's what the equity market and bond market, that's what investors are trying to kind of game or figure out as well, right? Because I think there are increasingly signs of a two-sided market after September, which was a very ugly month for risk assets of all kinds, including treasuries, which are supposedly risk-free. Clearly, they're not risk-free in 2022. And so investors are trying to get a sense of, are we really at a potential inflection point with the data? Not so much the Fed pivot, but the economic data. And really where people are honing in on is labor, as you mentioned, and rents, because those are the two big, traditionally sticky parts of U.S. inflation. And so I think the jobs number that's coming up on Friday will be important. You can see it today, right? In the ISM numbers, you had some employment suggestions there. And that's what I think the market is trading off on today, is a sign that maybe the JOLTS number yesterday, which was pretty supportive of a slowing labor market, which would suggest slowing inflation, that was very supportive for risk assets yesterday. Today, the data maybe suggests not so fast. And so I think the number, my sense is that the consensus for Friday is about 260,000 non-farm payroll jobs. To put that in comparison, the last 3-month average is about 380,000, and the 6-month average is about 440,000. So clearly the job market is ebbing in the U.S., which should suggest that wage pressures should ebb, and that together with the signs that rents are peaking and rolling over suggests that the data going forward should be a little bit more supportive of a peak and a slowing in inflation. And that again suggests that the Fed may not be as aggressive, and that's what I mean by a two-sided market. For the last 6, 9, 12 months, it's been all one way: inflation, 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 Fed aggressive, aggressive, aggressive. I wrote about that on my monthly called Extrapolation and Beyond. Here now, we may start to extrapolate lower inflation, lower Fed pressure, and that would be constructive for risk assets.
And Jay, if I understood well, for Friday, do you see 260,000? It's the number you said. Okay, perfect.
That's the consensus.
The consensus of market. Meanwhile, we are seeing to the trade deficit narrowed 4.3% to 67.4 billion in August. This is the lowest level since May 2021. Which analysis may we do about this data?
Well, I think, Marta, what's interesting here is that we've had a strong dollar, clearly, and yet it hasn't really negatively affected U.S. exports, right? The dollar is as strong as it's been in 20 years, and yet U.S. exports are quite strong. That's interesting, and suggests that the U.S. may be becoming a little bit more competitive. It also suggests, perhaps more importantly, that the Fed is not going to be worried about a strong dollar affecting the trade picture or exports for U.S. companies. And it also suggests that therefore the Fed is okay with the strong dollar, because remember, the strong dollar helps on the tightening of financial conditions side of things. And that's what the Fed, again, is trying to do and has done, is has tightened financial conditions pretty significantly. Real rates have gone up pretty significantly. And we saw last week at the end of September around the UK story and everything else, is that maybe there's signs of a little bit of fragility in financial markets, given this aggressive tightening of financial conditions and given this sharp backup in real yields. They are, at last week, they were at levels that traditionally has suggested the Fed starts to pay more attention to the issue of financial stability, as well as the issue of beating back inflation.
And Jay, we are seeing too, ISM services PMI has declined to 56.7 in September. It's better than expected. Business activity in the US service sector continued to expand this last month, and the S&P Global US services gets better at 49.3. Which are the main differences in both references, and what does this data say to us about the US economy?
Well, I mean, I think it suggests, as we've talked about for some time, right, the shift from goods to services. As we open up post-COVID, people go back out, they start to entertain, they travel. All those are service related. The points that I took away from the ISM, Marta, is that all the issues around supply chain concerns have really almost completely gone away. If you look at prices paid, if you look at supplier times, if you look at order backlogs, all those issues which were such a concern 3 months ago, 6 months ago, 9 months ago, no longer a concern. And that again suggests to me that the pressures which built up around COVID and the opening of the economy, closing of the economy, lockdowns, etc., we're finally starting to move out of that kind of very sharp, volatile period and getting back to something that resembles whatever the new normal is going to be for the US economy and for the global economy, as you pointed out. And then the other point I would mention to the issue of the global side of things is, remember, we at TPW Advisory have been talking about a desynchronized global economy. Not only the economy, but the monetary policy side as well, right? Every newspaper you read is focused on global rate hikes. But the 2 of the 4 major central banks, Fed and ECB, are tightening. Those are 2. Bank of Japan and the People's Bank of China are either standing pat or easing. And so when you look at the data, Japan's data continues to get better. Southeast Asia data is good. And we think China is bottoming and coming out of its lockdowns. And after their People's Party Congress in the next 10 days or so, we expect some more policy measures around the property sector to support the Chinese economy. So when we look into 2023, which now I think we have to start really focusing on 2023, we see a better global economy than a lot of people because of that desynchronized global expansion, because of Asia picking up while the US and Europe slow, and particularly as we approach the end of the Fed tightening cycle. We're closer to the end of the tightening cycle for the Fed than we are at the beginning. And that's, again, something I think risk assets will start to think about and sniff out over the next couple of months.
Thank you so much, Jay Pelosky from TPY Advisory. A pleasure.
Thank you, Marta. Always.
Y nosotros nos tenemos que trasladar en breves instantes a esa